So we're delighted to have our featured speaker right now. And actually, I was talking to Namir, and originally we were going to have this event on Thursday, and then we moved it to Friday, and we might have missed him. So I have to give him big accolades because Namir just flew in from all places, Las Vegas, last night too, and he's here bright and early this morning giving a talk on tax. So Namir and I actually met many years ago, actually, when he was with Deloitte. But we just haven't, in this day and age, we haven't actually seen each other in person for a long time. It's just been virtual. So it's great to see you in person here, Namir, and sharing your thoughts as well. So Namir is a Vancouver-based cross-border tax expert with 18 years of industry experience and public practice experience, specializing in tax compliance, planning, and provisions for multinational corporations with U.S. operations or investments. And Namir is passionate about helping business expand their footprint across the border, providing a tax lens into their planning strategies and the business tax implications of cross-border operations, mergers, and acquisitions. And I also understand that Namir's also went to school at Kansas too, so I'd say go Jayhawks before. So without further ado, I'll pass it over to Namir.
All right. Well, first of all, I want to say thank you to our hosts, BDC. This is an absolutely beautiful space to be in. If you're attending us virtually, hopefully you get a chance one day to check out this gorgeous space. And also thank you to the Maple Business Council for giving us this opportunity to talk today. So a little bit about Andersen. So Andersen provides tax, valuation, and financial advisory services to individuals and commercial clients. Our clients really come to us for comprehensive tax services. So we have 14,000 professionals worldwide. We're in over 170 countries. In the US, for example, we're in 23 cities with 1,700 staff. Our BC and Alberta practices really focus on all things tax. So Canadian, US, and cross-border, but cross-border tax is our specialization. And again, because we're a tax-only firm, we don't have to deal with a lot of conflict checks. So we can do tax provision computations, we can do tax advisory services without having those conflict checks. So what do we do? So we do corporate, partnership, trust, and estate individual tax return preparations. We also do surplus calcs. So for example, if you have a Canadian entity with foreign subsidiaries, we can help out with that as well. Customs and duties tax, so we also do indirect taxes. We also do Canadian US tax advisory services. So this can include structuring your business if you have a cross-border operation, international tax. So this can include anything in terms of things outside of US and Canadian tax. We need help with that as well. We also help with understanding the tax implications of how you want to finance your business. So we would work with organizations like BDC to help figure out what is a tax answer for your financing needs. And we also look at transfer pricing. So transfer pricing is really looking at the economics, the rules, and methods of pricing transactions between related parties. So if you have companies that are part of a common control or ownership, we would help out with that as well, especially if you are trading goods or services between those related companies. So we are committed to growth and excellence. And when you work with Andersen, you are getting access to a global network of professionals. Again, in BC and Alberta offices alone, we have 47 cross-border tax professionals. So our bread and butter really is talking US and Canadian tax. We're all well-versed in US and Canadian tax. So we're looking at it and we're well-versed in languages in both. We're not siloed out just talking only US or only Canadian. We try to look at it from the big picture. We've also had some significant growth. We've actually doubled in the last few years. So our corporate individual clients, they really are coming to us for US and Canadian tax advice services. I think when you're going to someone to talk, anything cross-border tax, I think it's really important to have someone who is well-versed in both languages, and hopefully they can throw a few tax or dad jokes here and there. I've got a few, I promise. Talking tax at 10 a.m. on a Friday is kind of brutal, so bear with me. I'll try my best. So why does the IRS hate Sherlock Holmes? Because he takes too many deductions, or he makes too many deductions. Sorry. All right, get started here. So one of the first things I talk about when you're looking at cross-border structuring is you want to ask some questions to really understand what is the business that you're working with. There are a lot of different strategies here that will come into play once you understand what the business is. So I'll want to know, what kind of income are you planning to make as a Canadian business going into the US? Are you more going to have active business, active trader business income, or is it more investment income, passive income, and that'll drive what is the right structure for you. So passive income being, if you're only going to make dividends and interest and royalties, that'll drive a different answer in terms of what is the right structure for you. Clients, as you can imagine, don't always anticipate the complexities of crossing this imaginary border. So one of the things we also want to often ask is, what does expanding to the US look like for you? And each client has a different answer. I mean, for them, they might say, well, we're really not doing much in the US. We're just selling to customers across 50 states. Or maybe we have our employees going down and performing some services. All of those can have very different answers depending on what exactly expanding to the US looks like for you. Maintaining US inventory, for example, if you have it for a warehouse for storage of goods, that'll have a very different answer than if you have employees going down and providing services to those customers. So we really want to know, what is it that you're doing in the US? Does it require actually going into a formal US cross-border structure, and how can we help you with that? The good news is, as a Canadian company, the US-Canada Treaty does offer you some relief. So a Canadian company can have substantial amount of activity in the US before you're going to get taxed in the US by the US federal government, by the IRS. So that threshold is what we call a permanent establishment. So we'll want to look at what are the type of activities you're doing in the US, and have you exceeded that permanent establishment threshold or not. The reality is, a lot of times we see our clients kind of first dipping their toes in the water and saying, okay, well, maybe we're going to just do some advertising in the US, just try to drive some customers to our Canadian business. Or maybe they're going to start adding some facilities in the US where they're really just trying to deliver the goods to their US customers. A lot of those type of activities, if you haven't quite hit that US permanent establishment threshold, you might have to file a US tax return, but you might not have to actually start taxes just yet, again, at the federal level. And you probably see this with BDC and other organizations, is clients tend to scale up. So they'll start, very simple, how they're organizing their business in the US, how they're expanding, and then that slowly starts to creep into that permanent establishment threshold. So we really try to talk to our clients in terms of, what is your cross-border strategy? What is your end game, and what are you trying to do with your US business? Are you hoping to minimize your overall taxes so you're not being subject to double taxes? Hopefully that's one primary goal. But often there's also a tax deferral opportunity in terms of saying, well, if I can, for example, retain my profits in a US entity and not necessarily take the cash out to my Canadian bank account as a shareholder, is that a potential planning opportunity for you? And so there's different ways of looking at what are you trying to achieve with your US cross-border strategy. And overall, hopefully you're hoping to also reduce your compliance burden. So that's not just tax returns, but overall maintaining books and accounts for several different entities. So the other question that we get often, let's assume they're beyond that threshold of having a permanent establishment. So we know they're in the US. We know that you're actually going to be subject to US taxes. One common question we get is, well, do I actually need a separate US entity, or can I just continue operating as a Canadian company doing business in the US? And again, this is really going to depend on what your long-term plan is for your Canadian business. If you're setting it up as just a Canadian company doing business in the US as a branch, that's usually the simplest answer. It works well in the short term. But again, it might sound like it saves you time and money because you're saying, well, I just have this Canadian entity doing business in the US. I'm going to keep it set up as a branch. I don't want to set up a US structure just yet. Again, that works well. And that also helps if, let's say, your Canadian company is losing money and your US business is profitable. You can use it to offset one against the other. So that could be a great tax outcome there. Foreign tax credits, you can use foreign tax credits, use one to offset the other as well. But there's actually some complexities in still operating as simply as having a Canadian entity in the US. And that's because you actually still have to track your costs separately between what's happening in the US branch versus that Canadian company. So you'll want to have a separate book and really a clear documentation of how are you coming up with your US branch profits, your income and deductions that you're using for that US business. But the other thing I just want to bring up here real quick, again, because this is one of those primary questions we get from clients in terms of saying, well, at what point should we start considering whether we need a US entity or not? And I'll tell you that if you're setting up right now where you have a Canadian company doing business in the US as this branch, Should you then later decide, well, I want to incorporate this branch, I want to take this branch and now put it into a US company, what does that look like? Well, that can actually get really expensive. And the reason for that is, assuming the value of your US business starts going up, so you have some appreciation in the value of what's in that branch under the Canadian company, there's actually a tax, there's a tax implications from a Canadian perspective, because the value that has gone up, you're going to have to pay tax on that from a Canadian perspective. Now, from a US perspective, if you incorporate that branch and you own over 80% of it, you could probably do it on a tax deferral basis. But again, there is a toll to pay on the Canadian side for incorporating that branch. The other really important consideration here is if your Canadian business also has any US real estate, and that US real estate is held by that branch, there's going to be also some US tax implications there as well. So questions we'd ask is, do you really need to keep it as a branch? Should you start thinking about setting up a US entity early before you start appreciating some value in that US business? The other thing to think about too is when you have a separate US legal entity, when you're starting to make money in that business, any cash that's going to go out of that US business, that's going to go back up to you as a Canadian shareholder, assuming you're a Canadian person sitting in Canada. There's usually going to be also some cross-border withholding taxes. That's also usually kind of surprising for some of our clients because they're thinking, well, I'm just moving it from one bank account to the next bank account. It's all part of my one company. Why do I have to pay taxes? I haven't done anything. It's the right hand feeding the left hand. But it might be an imaginary border for some, but not for the IRS and the CRA. So something to consider if you're crossing the border, there's going to be those withholding considerations. You also want to make sure that when you are going to set up that separate legal entity, that you're not going to be potentially, again, subject to double taxes. So the type of entity that you set up is going to be really important. And I bring that up because you'll see there are LLCs as an option for entities. So I talked earlier about why it's really important to talk to a cross-border tax person. I'll tell you why. We often get Canadian clients who say, you know what, I'm going to go to my US CPA or somebody in the US who's going to advise me what's the best way to hold my structure that I'm doing as a Canadian expanding to the US. And LLCs are really popular for Americans. They love the LLC. And the reason for that is they're quite cheap to administer. They're extremely flexible. So you're able to add a partner, you can remove a partner, there's a lot of, you get the flow through status, which means that as an owner of an LLC, whatever income or losses that structure makes, I can pick it up as an owner, as we call the member of the LLC, but I still get a legal liability protections. So, if something goes wrong with the LLC, they're not going to come after my personal assets. I'll only lose what I've contributed to that LLC. That all sounds great, but not so much for a Canadian. So Canada looked at that, CRA looked at that and said, I don't really like this because this sounds like you're quacking like a duck, which is, you sound like a C Corp, but then you're getting this flow through income pickup as a partnership. We're not going to respect this and we're going to treat this actually like it's a separate C Corp, a separate corporation. So what all that really means is that if you're a Canadian, talk to a US advisor and they say, go with an LLC. Most Americans are doing this, or my brother's friend's neighbor told me to do an LLC. That sounds like a great idea. If you are a Canadian, you're probably going to have a pretty adverse tax result if a lot of the management decisions that are being made for that entity are being done in Canada. So they look at mind and management to decide, where is the residency of this LLC? And if it is deemed to be in Canada, you could get double tax, which is kind of the worst case scenario that can happen there. So central management and control is going to be key in understanding which is the right entity for you if you're going down with the US structure. So one of the questions I ask with going for a US structure, if you decide that's the path you're going to go on, is tell me more about your mind and management. And when I say that, it's really trying to understand where are the management and strategic directions being made? Are they actually being made in Canada or are they actually being made in the LLC? And there's a lot of ways around this, right? Like it doesn't necessarily mean that all the directors of that entity need to be in the US. But if you're meeting together to make those decisions, you'll want to have really good documentation that tracks. And I'm talking, tell me dates and times of your travel from Canada to the US. If you are meeting, I want minutes of those meetings. I want to see what you're talking about. All those things are really just to make sure that at the end of the day, the residency of that entity is truly going to be treated as a US entity. And you're not going to have the CRA or the IRS come back and say, well, actually it's more the CRA is going to come back and say, I know you incorporated this in the US, and I know you have documentation from, let's say, a state in Delaware or Texas, but it looks like a lot of the management and strategic decisions are actually being made outside of the US. And that has implications not just for double taxation, but even when you're making profits out of that, for example, LLC, they're not going to be tax-free for the Canadian corporation. That could be the owner or you as a Canadian shareholder. So things to think about when you're looking at what's going to be the right US structure, and knowing it's not just about what's the right state for me, it's also stepping back and saying, where are we going to be making decisions for this entity as it grows, as we build this business? Are we going to have directors in Canada, or are we going to have this in the US? When we're looking at the end, this is another thing I want to bring up really quickly. So even though we're talking about a US structure, if you say a US structure is the right way to go, you want to check what is the CRA's classification of that entity. And I bring that up because there's really two things you want to know from a CRA's perspective in terms of what do they think of that US entity. One is, are they going to ask you to report at the entity level, or are they going to ask you to report at the shareholder level? So will there be a match with what the US is doing? And the other thing is, how is it getting taxed? So if the CRA sees the US entity as whatever profits you're making, we're going to tax this as they're being earned, that's essentially a partnership. That's a flow-through entity. Whereas if you have the other way around, where they say, we're going to take those profits and we're only going to tax them when you distribute it, that would be like your traditional corporation, assuming you're not subject to FAPI rule, which we're not going to get into. So I bring that up because you're going to have a situation, I brought up the LLC as an example, you're going to have a situation which could happen in which the classification of the entity for US purposes will be a mismatch for how Canada is classifying that entity. So when you have an entity mismatch where US and Canada see this, one sees it as a flow through, the other one sees it as a corporation, even though on paper you're saying, well, it's an LLC, it's a corporation, we have limited liability. If there is that mismatch, you can have some pretty adverse tax results. And that's something you want to be conscious of. So that, for example, if you have that mismatch, you have a hybrid mismatch. From the CRA perspective, you can lose the deduction you would otherwise get for any cash you pull out as dividends. And even from a US perspective, any deductions that are made can also be denied. And again, in a super extreme case, you can get double tax in both US and Canada for having set up the structure with a hybrid entity. The other thing I just want to bring up real quick, just because I think it's kind of peculiar and really acute for how US does things is, so generally speaking, US and Canada, the entities are going to be described if it's a corporation, if it's a partnership, if it's a trust, and it's done under a US state law. Generally, Canada is going to look at that and say, yeah, we're going to give you the same Canadian entity classification, generally speaking. But of course, it's the US, and so the US states love to create all sorts of variations on this. So we have all sorts of hybrid entities that make these classifications more problematic, and they're going to give me some tongue twisters. So here we go. So we've got limited partnerships. That kind of sounds like what we'd expect to be, which is a limited partnership. But then we have, which is an LP. Then you have limited liability partnership, which is an LLP. And then you have, wait for it, limited liability, limited partnerships. That's LLLP. Because of course they want to create more variations to it. All you need to know with that is if you see something more than, if it's not an LP, if you see an LLP or an LLLP, the CRA has come back and said, kind of similar thing with the LLC. We don't like how you're treating this. We're going to treat this also as a hybrid entity. So just something to be careful of. If you have a structure that's set up this way, or more commonly what happens is you're going into business with a US investor and they really like those structures for the way they're set up. The state rules have made them so that they create pretty favorable outcomes. I mean, it's enviable when you compare the tax result for a US versus a Canadian in those structures. Just be mindful that you're probably going to need some sort of cross-border structuring advice to ensure you don't get that adverse tax result as a Canadian owning any one of those hybrid structures. All right, here we go. So why did the tax accountant cross the border? Obviously to get the deductions on the other side. All right, so the other thing to consider is, what is your exit plan? So by the way, this is always really funny with clients because they're coming to us super excited about building their business. They're really excited about going into the US market. And then I started asking them, what is your exit plan? And you're maybe not necessarily thinking about that. And by the way, exit plan means lots of things. Exit plans could be, Are you planning on getting acquired by a US buyer? Are you looking to be, is this going to be your wealth plan? Is this going to be how you're going to create wealth for you and your family? Are you looking for exit plan? But also, have you thought about the taxpayers' debt, the shareholders that own this company? What are some of the considerations you're thinking about long term? And that's a difficult question because maybe they haven't thought about that. But I'll tell you why these things matter as a Canadian owning a business that's crossing the border. So the first thing is the small business corporation long-term capital gains exemption. So give me a second, I'll walk you through this. This is really important because Canadians will get a lifetime capital gains exemption on the disposition of a Canadian company's shares. Now, this is, I think, for 2023, with inflation adjustment, it's $971,000. So what that means is, should you decide you want to sell your business, you are eligible for that capital gains exemption. But there's a two-pronged test to meet that, whether you're going to be eligible for that long-term capital gains exemption. One is that it's a private corporation controlled by Canadian residents. Usually we meet that. That's not so bad. The second one, which is the trickier one, is the asset test. And essentially what this means is that they look at the overall fair market value of that Canadian company and say, are you deriving most of your assets from Canadian assets? And are most of those assets being used primarily being used, in a Canadian active business? And you look at other corporations that could be connected to that Canadian corporation. So why does this matter? How does this play out for us from a cross-border perspective? Well, if you're operating as a Canadian entity and you're doing business directly in the US, let's say you're doing it as a Canadian company with a branch, you've decided you're not going to set up a separate legal entity. Well, all the assets of your Canadian company that are related to that US branch, those are going to be entirely treated as ineligible assets. So you could potentially lose that lifetime capital gains exemption that you're holding on to by the assets that you have in that branch for the US business. That's one. And by the way, this is why it's important too. We do ask these questions, it's kind of like playing Shark Tank, but as a tax geek. So I started asking them well, where do you see your business going? In terms of, do you really see this growing? Tell me the value of what you think this business is going to do, which is really fun. And the reason for that is I want to know whether the value of that US business is going to grow substantially enough so that they would now be ineligible to get access to that lifetime capital gains exemption. The other thing, obviously, is if you actually start to set up the business instead of having it as a branch, you want to have it as a separate legal entity. The shares of that US entity that you own, whether you are the Canadian parent company or your connected corporation, any equity or debt, so any financing that you also have in that US business, those would be ineligible assets. So the reason all this matters is, again, you want to look at what is the shareholder's personal financial plan? Are they planning to use this and exit and get access to that lifetime capital gains exemption? If it is, then maybe you'll want to structure this in a way so that their US business is not going to be treated as an ineligible asset, and then they lose that benefit as a Canadian shareholder. The other thing I just want to mention here real quick is just mentioning your ability to restructure on a tax-deferred basis. So again, if you're set up initially as a branch, it can be really expensive to restructure this and incorporate it as a US corporation if the value of that business has gone up. The other thing to keep in mind is if there are any losses in that business, those losses could be deemed to be nil, so that's zero. Again, because there's some stop loss rules. I'm not going to get into that, don't worry. For Canadian businesses, if they incorporate that branch into a US entity. The other thing to keep in mind, again, I bring that up because it's important, is US real estate. So the US will generally allow a tax-deferred, which basically means you can transfer those assets at a tax-deferred basis. You're not going to pay the US taxes. But if there is US real estate, there are some reporting and withholding obligations there, something to keep in mind. The other thing I want to bring up real quick is estate taxes, not real estate, but estate taxes. What you need to know here is if the US company, so if you own a US entity and those shares are owned directly by an individual, there are some US estate tax considerations. Now, this is applicable to high net worth individuals. And this, by the way, doesn't matter if you're not a US person, you're not a US citizen, you're not a US green card holder, you're not a US resident. just by nature of owning US corporate shares, you could be subject to the US estate taxes. And these are triggered upon the death of that taxpayer. And so there is obviously some criteria you have to meet there, but generally the difference between US and Canadian estate taxes is your tax at the death of the taxpayer on the fair market value of the estate, not on its appreciation in value. That's, which can be quite significant. And, shares of the US corporation, regardless of where those shares are held, are going to be subject to US estate taxes. On the other hand, if you have shares of a Canadian company, those would not be subject to US estate taxes. Now, the good news here is I did say high net worth individuals. So the US-Canada Treaty does offer some relief. So you're generally not going to be subject on estate taxes for your worldwide assets unless they exceed $12.9 US $12.9 million. But the marginal tax goes as high as 40%. And just one thing to keep in mind is even if you're below that threshold, if the value of that company is at least $60,000, you still actually have to do some US filings and reporting to show that you own that US company. So real quick here, just when we're talking to clients and we're talking, in terms of structuring an exit plan, it's actually really important to get a little personal with clients on this and start asking them, all right, so we understand what potentially your long-term plans are, but what are your personal plans? Do you plan on moving to the US? Do you want to go somewhere sunny during the wintertime? What are you and your family situation look like? And it's always kind of funny, again, as a tax person asking, what are your personal plans and how are things with, winters for you in Calgary? But, we have to ask this, and I'll tell you why, because the structure that you get as a Canadian owning a US entity, going inbound to the US, will look very different once you move to the US. So that structure could be quite a bad answer if you're going to stick to it having owning a Canadian company, but now you've moved to the US. So it's really important to, if there is plans to move to the US, to at least ensure there's some flexibility in how the structure is set up, so that if there is a move to the US, we can incorporate that as a variable. Another variable I want to add to the question is, when you're looking at what is the right US structure, I'm talking about this obviously entirely from a Canadian perspective going down to the US. But often that's, it's not as vanilla of a circumstance as that. Sometimes they have other US investors in the picture, for example. They'll have very specific criteria for what those US investors want to go into business with a Canadian. And often, if you're looking for how you want to exit out of the structure, American buyers, when you're looking at an M&A deal, generally would not want to go, for example, with a Canadian parent company. They'll want to make sure if they're buying your US business, they're really buying a US structure, not necessarily a Canadian top parent company. And also how US investors want to go in business with you may not necessarily be as a corporation. They may want to have some sort of flow through, like a partnership or an LLC or any other way that may not be as favorable for Canadians. So it's something to consider when you're looking at what's going to be the right structure for you. All right, we're down to the last slide here, but obviously we have one more. Why are accounting departments the most welcoming? Because they know everyone counts. All right, so one last thing here with US state taxes. I bring this up because I'm actually, a lot of times when we're involved with M&A deals for cross-border operations, state tax is the one that they usually fail primarily in. And that's kind of interesting because when Canadians think about state taxes, they don't necessarily anticipate that this is going to be a major exposure for them. And the key thing to remember there is that the US, unlike Canada, it doesn't have a federal sales tax. In fact, the sales tax that are done for US is done at 14,000 jurisdictions, over 14,000 jurisdictions. So when they're drilling down to what state and local or use tax that you have, you really have to drill down to state, county, and city or town level. So there's a lot of exposure that Canadians may not anticipate just because Canada kind of conglomerates that all together as a federal sales tax. And really, sales tax is going to be generally dependent on the location where the customer receives the product. Use tax, if you heard of it, it's basically if you have a good that's purchased outside of the state and then it's used in the state. So there's a couple of things to think about here. We talked earlier about the US-Canada Treaty. That's great. It provides some federal protections so that you're not subject to US federal taxes unless you reach that permanent establishment threshold. Now, a lot of states looked at that and said, well, that's cute, but that doesn't really apply to us. So a lot of states have decided they don't actually adopt the US-Canada treaty. And that's going to be pretty important because that generally means that Canadians could be subject to state taxes. And that could be, again, state income taxes, it could be state sales taxes. And now, interestingly enough, the US Constitution actually provides protections to ensure that there's interstate commerce. So they want to make sure that companies that are based in the US are able to sell goods across state lines and are not going to be subject to tax every time they cross a border. But a lot of states have come back and said, well, that's nice, but that also only applies for US interstate commerce. It actually doesn't apply to non-US customers. So when they look at it, some states go out of their way to provide language to say, okay, we'll extend this to non-US corporations. But a good reminder here is that states like California, New York, Texas, they're pretty cash strapped. I mean, I think they've been pretty cash strapped for years. So if anyone's going to go after your taxes and they're going to have a much lower threshold in terms of who they're going to go after, it's usually going to be states and not the IRS. One last thing just to add here, just kind of a change in the landscape is there was a Wayfair decision that came out, and that was in the end of 2017. What you need to know here is, I think the reason why a lot of Canadian clients generally have failed this state tax piece on their M&As is that if you didn't have physical presence in the US, you generally would not have been subject to US state taxes. And that's kind of the general broad, I would say, guideline that they've used. I'm not sure how technically accurate that would have been pre-Wayfair. But what you need to know is that what the Wayfair decision did, and this is a decision that went to the Supreme Court, is they essentially threw out that physical presence requirement. And really, if you think about it, this leveled the playing field. Because if you were somebody who was operating, let's say, through Amazon versus somebody who had a brick and mortar store, let's say, in Iowa, well, of course, you're going to buy the product off Amazon because then you're not subject to, let's say, sales taxes. So what the Wayfair decision said, you know what? It doesn't matter if you're not in the state. We're going to level the playing field so that somebody who's buying a product from a company that's based in Canada or the brick and mortar store in Iowa, for example, you're both going to be subject to the same sales taxes. So that's just something to think about, is if you are operating in the US, you really need to be cognizant of the 14,000 plus jurisdictions that you might be subject to taxes in. And just know that the threshold is much lower than federal. And that's because the US-Canada Treaty is not necessarily adopted by all 50 states. So I've got, I'm out of accounting jokes, and thank you for today's session. Does anyone have any questions?
Yes, I have a question.
Sure, yeah.
Yeah, I'm Claire Walters from BDC, and one situation that I and my colleagues quite often come across is that we'll start to work with a client who already is operating in the US, but hasn't had the advantage of great advice on how to establish, so they're really suboptimally set up. And I'd be interested in what your advice would be, Namir, for such a client, you know, in terms of what can they do to restructure, what are the range of options versus should they sort of park that, set up another entity and house all growth within the new entity, which is optimized. So any thoughts on that would be great.
Yeah, I mean, it really depends on the type of structure that they have. I would say it really, it's going to be driven by what are their current plans in terms of how do they want to be set up in the US, and what are their long-term strategic plan for their US operations. If, for example, they're looking to grow that US business, they're looking for that to be part of one of many businesses in the US, you know, that structure might look very different in the way they have it set up. But I would say the primary driver of, do I need to restructure this or can I keep it as is? Do I need something separate? Really will be driven by the value of where the company is today from its inception to today. If it has grown in value, I mean, there's going to be some tax implications there. But you'd want to evaluate that before, especially before, if you can, before the value of that operations has gone up. And part of that, by the way, is dependent on, for example, with that example you have, where is the IP of that company? Where is the value that's being generated for that company? And sometimes clients don't know that answer right offhand. They might be setting up a US business because a lot of times American clients will tell you, I want to see made in the USA before I can buy your product. So they'll go ahead and set up a US shop. And that's fine. But I think as your footprint in the US grows, and that's usually kind of the scenario we get where clients are already set up in the US, they might already have a structure in place, but that answer will change as their value grows, as the value they have in the US grows as well in terms of people, product, and IP in the US. And so that might trigger, okay, it's time for a restructure, potentially with your cross-border setup.
Okay, that's helpful. So range of options depending on how they're currently set up. Then one small question around early in the presentation, you mentioned the minimum threshold below which you can sort of fly below the radar, I guess, to an extent. Yeah. Roughly, what is that?
So it's funny, we get this question quite a bit, especially from a dollar perspective. So it's actually not a dollar value. You can actually have hundreds of millions of dollars of sales in the US and still not be subject to US federal taxes. So the permanent establishment threshold, which I think was referring to, that's what you're referring to, that is essentially in the US-Canada treaty, there's several ways to get there, but it's not based on volume of activity. It's not based on volume of sales. It's actually based on your activity in the US. And there's several ways to get there. So one of them is, for example, if you have employees signing contracts in the US, so they're actually concluding on the sale in the US, that would establish a permanent establishment. The other one that's more traditional, just because permanent establishment sounds like something permanent, is if you have a fixed place of business in the US, if you have an actual store in the US, an actual location where you're doing business primarily from, that could be manufacturing facility, that would create also a permanent establishment. The other more common one is around if you are not necessarily selling a tangible product, widget, then it would be around services. So if you have a services company where you're performing services for US customers, depending on the number of days you're performing that service in the US, that can trigger a permanent establishment. But if you're below that threshold, then you wouldn't. So an interesting example for you there is if you have a doctor who's doing, let's say, MRI imaging, and he's doing all that analysis in Vancouver, but all his customers are in the US, and he's performing services for those US customers, but primarily he's doing all that work out of his office in Vancouver, he's not subject to US federal taxes because those services are performed all in Canada. So Canada gets first dibs on taxing that income.
Interesting. And what about a warehouse? So just thinking about logistics, does that constitute permanent establishment? Usually
not, and here's why. So that's usually kind of, when I talked about kind of scaling it up, it's almost like a dimmer. I would say a lot of clients, that's how they usually first start doing business in the US. They'll get a warehouse, or even they'll talk to, for example, a Costco and say, can we have, show our products on one of your shelves? Any one of those activities would not subject you to US federal taxes. It's considered below the permanent establishment threshold. Now that, by the way, that's a very different answer for a state. States will look at you and say, oh, you have a product in our state. If it's not a one-off, you have physical presence in our state, for example, through a warehouse, that'll subject you to filing requirement at minimum in that state. You may not be subject to taxes just yet, but at minimum, they'll say you have enough activity in our state that you have a filing requirement. States are just a lot more aggressive. Okay. And they can create their own rules. Like, that's the crazy part about it. Like, you have 50 states who each decide, oh, that's really nice. I love what the US-Canada Treaty, is trying to do, but some follow and some don't. Interestingly enough, none of the states that border Canada follow the US-Canada Treaty. Because they look at that and say, well, obviously I want that money. I'm going to not provide this protection. It does nothing for us. And think about it I'm not getting into politics, but think about it from a political perspective. That's not their constituents, right? So if I tax these foreigners, I'm not going to lose my voter base. I'm just going to get more income.
Interesting. Yeah, good to know. Okay, thanks. That's perfect.
I think you had a question. Yeah, sorry.
You have like a non-physical business, an e-commerce business. Does it matter how we consider which state you set up?
So this question comes up quite a bit as well. So I think where you incorporate as a state, as a U.S. entity, is that your question? Yes. So that's usually a legal question and not a tax question. And the reason for that, so often people come to me and say, well, I want to do it in Delaware. What do you think of Delaware? And the reason a lot of entities incorporate in Delaware is there's a lot of case precedent there. So you'll have some legal certainty in terms of knowing what will be the outcome should any litigation happen for my corporation by incorporating in that state. So it gives you that legal certainty to know what will happen should anything go wrong. And there's a lot of just case precedent for a lot of different situations that can happen. From a tax perspective, if you, for example, incorporate, let's say in Delaware, Nevada, Washington, you're not going to be subject to any corporate income taxes because those states just don't have, unless you're doing activity in that state, you're not going to be subject to those taxes. Actually, Washington only has what we call a B&O tax, which is really a tax on your sales, and it's not really a tax on your income. But generally, I would say incorporate where you're going to do business. The Delaware versus other states is really more of a legal question than a tax question in terms of, do you want that legal certainty or not? Go for it. If
you're a Canadian corporation and you have a gain on a foreign exchange hedge, how is that looked at from a tax perspective? Because I have no idea. From a
Canadian corporate perspective, yeah. So you're going to get taxed based on that in Canada, not in the U.S., because you're a Canadian resident. And is it realized or unrealized?
That's realized.
So you realize you'll be subject to taxes in Canada for that.
Okay, cool. And it's just
not the unrealized part, though.
Okay, all right. Because the unknown that could get pretty interesting, really, if you have FX losses that are unrealized and you whack them straight into your income.
That's right.
That could be gaming system.
That's right. That's right. That's right.
Okay.
Fine. Maybe you have any better tax jokes? Your own profession jokes? No? Okay. Good? Okay. Thanks, everyone. Appreciate your time.